If you watch the breakdown of the 7-stage reserve currency death cycle, you already know one uncomfortable truth. The US dollar is not at the beginning of its story. It's in stage 5, the phase where empires try to save themselves with debt, money printing, and financial engineering. What this video will show you is what almost nobody wants to look at. Stage 6 and Stage 7, the final 2 chapters. Not as vague someday risks, but as a timeline running from 2025 to 2035, with specific triggers, patterns, and consequences that have already played out before. We've seen this movie 4 times: Portugal, the Netherlands, Britain, and now America. The last one, Britain's pound from 1945 to 1967, is documented in painful detail, month by month, devaluation by devaluation, crisis by crisis. And when you lay that path over the dollar, the dates line up in a way that's impossible to ignore. Britain entered stage 5 in 1945 and hit full stage 7 collapse by 1967, 22 years. The dollar entered stage 5 in 2008 when the Federal Reserve started quantitative easing and never really stopped. That was 17 years ago. The historical average from stage 5 to full collapse is about 18 years. In this video, we're going to walk through exactly what stage 6, loss of confidence and search for alternatives, and stage 7, replacement and collapse, actually look like, then map them onto the 2025 to 2035 window for the dollar. What happens first, what comes next, what breaks last, and what people who don't want to lose 70–80% of their purchasing power need to do while there is still time. Stage 5 is the phase no empire ever escapes from unchanged. It's the moment a reserve currency begins relying on debt expansion, financialization, and money printing instead of real economic strength. For the United States, Stage 5 began in 2008 when the Federal Reserve launched the first large-scale quantitative easing program, injecting trillions into the system to prevent a deflationary collapse. That decision marked the exact transition that every previous reserve currency experienced before their decline. Short-term survival purchased at the cost of long-term stability. To understand why this matters, look at the pattern. When Portugal's real, the Dutch guilder, and Britain's pound entered stage 5, their governments all followed the same script: issue massive debt, suppress interest rates, and rely on financial engineering to maintain the illusion of strength. It works for a while. It always works for a while. But it also always leads to the next phase. What makes the dollar situation even more precarious is that stage 5 for the US has lasted 17 years, far longer than the historical average of 6–10 years, because the Fed doubled down repeatedly: QE2, QE3, Operation Twist, zero-rate policy, pandemic stimulus, and the post-2020 liquidity wave that dwarfed every intervention before it. In every earlier currency cycle, this prolonged financialization created a widening gap between the currency's global role and the nation's real productive capacity. The same gap exists now. America's financial system has grown far faster than its industrial base, its government spending far faster than its revenues, and its debt far faster than its GDP. Stage 5 is the moment when the world begins to sense that imbalance, even if the dominant nation refuses to see it. And as we move into 2025, the dollar sits at the exact position Britain did in 1945, holding on to global dominance, but doing so with tools that signal the empire's peak is already behind it. Stage 6 begins the moment the world quietly realizes a reserve currency is no longer what it used to be, and holders start searching for safer alternatives long before the collapse becomes visible. For Britain, this turning point arrived in 1945, at the end of World War II. On paper, Britain had won. In reality, its industrial base was shattered, its empire was splintering, and it was drowning in debt to the United States. The pound was still officially valued at $4.30, but that number was a fiction maintained only through emergency loans. Britain had to beg Washington for a $375 billion lifeline just to avoid immediate devaluation, and that loan came with a poison pill. The pound had to be made fully convertible within a year. When convertibility began in 1947, the world's reaction was instant and brutal. Investors dumped the pound for dollars so quickly that Britain lost 1/4 of its foreign reserves in just 6 weeks. Convertibility was suspended, and the message to global markets was unmistakable. The pound's dominance was a facade held together by political prestige, not economic strength. But the real fracture arrived in September 1949, when Britain could no longer defend the artificial exchange rate and was forced to devalue the pound to $2.80. Holders of pounds saw an overnight 30% loss in purchasing power. If you were a British saver, a pensioner, or an institution holding British-denominated bonds, nearly 1/3 of your wealth vanished in a single announcement. Confidence once broken never recovers cleanly. Through the 1950s, central banks that had historically kept 80–90% of their reserves in pounds began to diversify, not suddenly, but slowly and steadily. Their logic was simple. The first devaluation was a warning, the next would be worse. By 1955, the US dollar had overtaken the pound as the world's largest reserve currency, and Britain's share of global trade continued to shrink. The decisive psychological break came in 1956 with the Suez Crisis, when the United States threatened to dump British bonds to force Britain to withdraw its military operation. A country that had ruled the world's oceans for a century was now dependent on Washington's approval to act. Markets recognized immediately that Britain was no longer a superpower, and capital outflows accelerated. By 1960, capital controls were imposed. British citizens needed government permission to invest abroad, a desperate attempt to slow the bleeding. This is the essence of Stage 6, years of denial, punctuated by unmistakable signals that only those paying close attention recognize. It is long, slow, and deceptively quiet. And it is the stage the US dollar is now entering. Stage 7 is where denial ends and consequences arrive. It is the phase when a reserve currency is no longer slowly losing ground, it is being replaced, and the collapse becomes visible not only in charts, but in the daily lives of the people who still hold it. For Britain, Stage 7 began around 1960, when capital flight, which had been quiet and elite-driven throughout the 1950s, suddenly accelerated. Wealthy British families, corporations, and banks in the City of London were quietly opening accounts in New York and Switzerland, moving money out before the next devaluation hit. Once again, the pattern was subtle at first, but the government's response revealed everything. Instead of stabilizing the currency, Britain tried to trap capital. Tighter and tighter controls were imposed. Citizens needed permission to send money abroad. Companies faced restrictions on foreign investments. The message was unmistakable. The government feared an exodus, and the pound could no longer be defended by confidence alone. By 1964, Britain was losing foreign reserves at a pace that was mathematically impossible to sustain. To keep the pound from collapsing, the government had to beg the International Monetary Fund for emergency loans, a humiliating retreat for a nation that had once controlled the world's most powerful empire. But even that was not enough. In November 1967, the inevitable happened. Britain devalued the pound again, from $2.80 to $2.40, wiping out another 14% of the currency's value overnight. Savers who had endured the first devaluation in 1949 were hit a second time. For the British middle class, anyone with cash savings, insurance policies, or pension-linked assets, this was a devastating blow. But the real destruction came in the aftermath. Devaluation triggered a surge in import prices: oil, food, manufactured goods. Because Britain relied heavily on foreign supplies, inflation rose quickly, hitting 7% by 1968 and continuing through the 1970s. Combine two major devaluations with decades of inflation, and the result was catastrophic. A British worker or retiree holding £100,000 in 1945 had purchasing power equivalent to about $400,000. By 1907, that same $100,000 had the real-world value of roughly $130,000, and by the early 1980s, it was worth just $50,000 in real terms. An 87% collapse in purchasing power over a single working lifetime. This is the brutal reality of Stage 7. The destruction does not come from a single event, but from a chain reaction of devaluation, inflation, capital flight, and loss of global relevance. Britain remained a wealthy nation, but the pound was no longer a world currency. London stayed a financial hub, but its transactions increasingly took place in US dollars, not sterling. The world had moved on. The reserve currency torch had passed, and Britain's middle class, the ones who believed the pound was too important to fail, paid the price. This is the pattern every dying reserve currency follows, and this is the pattern the US dollar is now stepping into. Stage 6 may be the warning phase, but Stage 4 is the hinge, the point where the pattern shifts from historical analogy to present-day reality, and the timeline of Britain's fall becomes a blueprint for the 2025 to 2035 dollar cycle. To understand why the dollar is now entering the same irreversible sequence, you have to look at the indicators that mark the early decline of every past reserve currency. Indicators that appear slowly, quietly, and then all at once. The first is reserve diversification, the moment foreign governments begin reducing exposure to the dominant currency. For Britain, this began in the late 1940s, when countries that once held 80–90% of their reserves in pounds sterling started reallocating into dollars and gold. It didn't happen overnight. It happened drip by drip. But by 1955, the pound had already lost global dominance. The same shift is happening right now with the US dollar. Since 2014, China has reduced its official dollar reserves from over $4 trillion to around $3.2 trillion. Russia liquidated almost all of its US Treasury holdings after sanctions. Saudi Arabia, the cornerstone of the petrodollar system, broke precedent in 2023 by accepting yuan for oil, the first crack in a 50-year structure that anchored global demand for dollars. And the BRICS nations, representing 40% of world population and 25% of global GDP, announced plans for a new trade currency in 2023, the modern equivalent of countries whispering about abandoning sterling in the 1950s. The second critical indicator is accelerating gold accumulation. In Britain's decline, central banks diversified out of pounds and into US dollars and gold. Today, the world is diversifying out of dollars the same way. In 2022 and 2023, global central banks bought more than 1,000 tons of gold per year, the highest since 1950. China, India, Turkey, and Russia are leading the surge, mirroring the exact pattern that preceded the pound's collapse. Gold buying is not symbolic. It is a vote against future dollar stability, and those votes are piling up fast. The third indicator, and the most dangerous, is trade settlement bypassing the reserve currency. In the 1950s, the British pound died because the world began settling more transactions in dollars. Britain was still a major economy, but the plumbing of global trade had shifted. The same thing is happening to the dollar. In the last 3 years, China and Brazil agreed to settle trade in yuan. India and the UAE agreed to settle oil purchases in rupees. ASEAN nations publicly announced plans to reduce reliance on the dollar for regional trade. Even France, a US ally, settled a major LNG shipment in yuan in 2023. These are not symbolic gestures. They are Stage 6 markers accelerating the progression towards Stage 7. And once trade settlement shifts, reserve allocation follows. The fourth indicator is geopolitical fragmentation, which always speeds up currency transitions. Britain's decline accelerated after the Suez Crisis in 1956, a single geopolitical event that exposed Britain's loss of strategic autonomy. The modern equivalent is unfolding across multiple fronts. US-China rivalry, the Russia-Ukraine war, sanctions regimes that freeze sovereign assets, and an emerging world divided into competing economic blocs. Every time a nation moves away from the dollar system to avoid sanctions risk, that is another piece of the global economy slipping out of Washington's orbit. Behind the scenes, smart money is already positioning. Sovereign wealth funds are diversifying. Central banks are reducing exposure. Commodity exporting nations are preparing for a multipolar settlement system. And while the public narrative still insists the dollar is strong, the structural indicators, the same ones that predicted the pound's fall, say otherwise. This is why stage transitions always follow the same rhythm: denial, diversification, acceleration, crisis. The dollar is now squarely in the diversification phase, with acceleration already visible in trade flows and gold reserves. What comes next is not speculation, it is the natural continuation of a pattern repeated 4 times in 6 centuries. And every sign says the US is moving from stage 6 into the earliest edge of stage 7, right on schedule. Stage 5 is the phase where the illusion finally breaks. Not publicly, not in the headlines, but beneath the surface, inside the balance sheets of governments, central banks, and global institutions that quietly admit to themselves that the reserve currency can no longer be defended without extraordinary intervention. In Britain's case, Stage 5 unfolded between 1955 and 1960, a 5-year window when the numbers no longer matched the narrative. Britain insisted the pound was stable, strong, and still the backbone of global trade. But behind the scenes, the fundamentals were collapsing. The same fracture is now forming in the US dollar, the moment when the story told to the public drifts further and further away from what the data shows, when the mathematics no longer support the mythology, and when the system becomes dependent on increasingly extreme measures just to stay afloat. For Britain, the beginning of Stage 5 was marked by a simple but devastating fact. The pound was overvalued and no longer reflected the economy that backed it. British manufacturing, which once dominated global exports, was being overtaken by Germany, Japan, and the rising industrial power of the United States. Britain's share of global trade was falling every year, yet the pound maintained a prestige pricing that made no economic sense. The only way to preserve that illusion was through constant borrowing, new debt, and increasingly complicated financial tricks. By 1955, the pound had already lost its reserve currency leadership to the dollar, but Britain continued acting as if nothing had changed. The government denied the need for devaluation. Central banks continued defending the pound's artificial value, and markets pretended to believe them, until the numbers made belief impossible. This is precisely where the US dollar stands entering 2025. The dollar remains the dominant global currency, but the fundamentals that supported its dominance for the last 80 years are eroding. The US debt to GDP ratio has passed 130%, a level historically associated not with strength, but with crisis. The federal government must borrow $1 trillion every 100 days, a pace that no reserve currency in history has sustained without collapse. Foreign holdings of US Treasuries peaked at $7.6 trillion in 2021. Today, they have fallen below $7 trillion, the largest and fastest decline on record. And for the first time in modern history, the US must issue new debt not to fund investment or growth, but simply to pay the interest on the old debt, the mathematical definition of a currency entering its terminal phase. Stage 5 for Britain also produced a second critical failure: the collapse of trust in government promises. British leaders insisted that the pound was stable, that the financial system was sound, that inflation was temporary, and that foreign investors had no reason to run. But every attempt to reassure the public required increasingly extreme actions: more capital controls, more IMF borrowing, more foreign policy concessions, more political compromises. The louder the reassurances, the more obvious it became that Britain was losing control. For the US, the same dynamic is emerging now. The Federal Reserve must perform contradictory tasks: fighting inflation while stabilizing treasury markets, raising interest rates while protecting banks, printing money while insisting inflation is under control. Each of these is mathematically incompatible. The system can be held together temporarily, but only through increasingly intrusive interventions, the modern equivalent of Britain's IMF bailouts and capital restrictions. A third defining feature of Stage 5 is domestic political fragmentation, which accelerates currency decline. Britain in the 1950s was marked by unstable governments, rapid leadership changes, labor strikes, and internal disagreements about how to save the pound. When a nation loses global economic dominance, political division fills the void. The US has entered the same pattern. Polarization is at its highest level since the 1860s. Fiscal policy has become hostage to political brinkmanship. Government shutdown threats recur like clockwork, and no political party can credibly commit to long-term fiscal discipline. Every reserve currency collapse in history has been preceded by the same internal fragmentation, not because politics destroy the currency, but because a weakening currency amplifies political anxiety and accelerates institutional decay. The final sign of Stage 5 is the most dangerous: the widening gap between nominal strength and real strength. In the mid-1950s, the pound looked strong on paper. It traded at a high exchange rate. It was still used in global trade. It was still held in central bank reserves. But these strengths were illusions. They were based on inertia, habit, and the lingering prestige of an empire that no longer existed. The real strength of the pound, industrial output, global influence, trade flows, confidence, was collapsing. Today's dollar is in the same condition. Markets still treat it as the safest asset. Trade contracts still default to it. Central banks still hold it. But beneath the surface, the numbers tell a different story. Rising gold accumulation, shrinking foreign treasury demand, accelerating trade settlement in local currencies, and growing blocks of nations openly preparing for a post-dollar world. Stage 5 is the final moment when the system still works, but only because the consequences have not yet arrived. It is the final window when those who understand the pattern can still move, reposition, and protect themselves before the transition into Stage 6, and Stage 7 makes the collapse visible to everyone. Britain had this window in the 1950s. Those who waited lost everything. Those who acted preserved their wealth for generations. The United States now stands at the exact same crossroads, with the same warnings, the same mathematics, and the same trajectory. The only variable left is whether people recognize Stage 5 for what it truly is, the last chapter before the crisis begins. The final truth about every reserve currency collapse is brutally simple. The downfall is never sudden, only the realization is. For Britain, people spent 20 years insisting the pound was stable right up until the moment it wasn't. And when the collapse finally came in 1967, it didn't matter what anyone believed. Mathematics overruled politics. Trade flows overruled prestige. Reality overruled narrative. The same moment is coming for the US dollar, and the transition from Stage 6 to Stage 7 will not wait for public consensus. The indicators are already flashing. Shrinking foreign treasury demand, rising central bank gold reserves, new trade agreements bypassing the dollar, and the emergence of powerful currency blocks preparing for a post-dollar world. These are not theories, they are signals, the same signals that appeared before every reserve currency in history collapsed. And once the world shifts, it never shifts back. This is why the next decade will be the most important financial period of your lifetime. Not because the dollar will disappear, but because the world built around it will. A new system will rise, trade will reconfigure, wealth will migrate, and those who prepared early will step into the new era with their purchasing power intact. Those who didn't will discover the same fate Britain's savers faced in the 1960s. Decades of accumulated wealth erased in a matter of months. You cannot control the cycle. You cannot stop Stage 7. But you can choose whether you enter it blind or informed, exposed or protected. Over the next 10 years on this channel, I'll be tracking every indicator that matters: reserve flows, trade shifts, devaluation triggers, geopolitical fractures. and walking you through how the transition unfolds in real time. Because this isn't about fear, it's about clarity. It's about recognizing a pattern that has never failed and positioning yourself before the world reaches the point of no return. If you're serious about understanding what comes next and safeguarding everything you've built, subscribe now. The countdown to Stage 7 has already begun.